Thank you for tuning into the list. I am here with Alex Nisenker. He is Vice President of Private Capital Markets with Greybrook Realty Partners. I am very excited to share some of the nuances and details of what Alex is able to provide to myself and clients. And without further ado, Alex.
Hey, Lani, thanks for having me. Very, very happy to be here as well and do my song and dance.
Thank you. I'm happy to share all the great details and things that you've got to share with us. So, without, I think, too much sort of context here, I think that maybe I'll just sort of go in and high level discuss some of the things that you do, and then really sort of give you the floor. And there's a few different talking points I wanted to sort of make sure that we hit. So,
Sure.
hitting it directly. So, Greybrook is private capital. What you're doing is you are working with builders and offering some pre-construction and sort of pre-construction alternatives to investors that are looking to be involved in real estate as an asset class without necessarily some of the both pros and cons of being a landlord, although that option also remains. So, did you want to more properly summarize some of the things that you do?
Yeah, so I mean, Greybrook is a private equity firm. We are entirely focused on real estate as an asset class. So within the world of PE, firms will sometimes delve into different industries and play different roles within their firm. We're more hyper focused and we're vertically integrated. So essentially, what we do is we develop and build real estate all across North America. And as we sort of take on new projects and as we identify projects that we're interested in pursuing, we will raise equity. We will raise capital to get those projects off the ground from our investor base, and that's essentially done via private equity offerings. So every single project is its own LP, its own limited partnership, and our investors have the ability to, kind of in an a la carte way, select which projects they're interested in pursuing as an investor and which projects, don't fit into their investment criteria. So, I mean, the
So,
best sort of analogy I use for private equity is that, it is equity. So if you sort of think about owning a share of like a private stock or a public stock, let's say you have a share of Apple, you're a shareholder of Apple as a corporation. That is a public equity. It trades on the public markets. In the world of private equity, it's very similar, except it doesn't trade on the public markets. It's private, so you have to have access to the deal flow or be invited to participate to be a shareholder in that private entity. In our case, the private entity is the limited partnership for the project. So, for example, right now we have an offering for a project at Queensway in Islington called Queensway 4. So you would be invited to participate as a private equity shareholder in Queensway 4 LP, limited partnership, which would essentially give you a share of the entire sort of development of that project. So that's the best analogy is comparing it to I guess a public equity with the caveat that in private equity it's all done by invitation.
thank you. So, a lot to digest there, obviously. So, you spoke on a few different points, which is fantastic. So let's sort of just talk about a little bit about private equity in general, because typically this is really closed door thing. It's a very, maybe secretive isn't the right word, but secured sort of quiet thing that not everybody necessarily has all the true ins and outs and understanding. And normally it's like really the who's who, those who have, true intergenerational wealth that are funding and sort of behind the scenes financing these projects. So what you said basically there was that you're sourcing from, the everyday investor, you had said
Yeah,
previously
so
to
I
me.
mean, every PE firm structures sort of their capital stack differently, right? So some PE firms will only work with the institutional investors or sovereign wealth funds or family offices, which is a strategy that they deploy. Other PE firms will sort of fall somewhere in the middle, and Our firm Greybrook, for example, we're sort of catering to the everyday investor, and that means someone that has the capacity to invest, the sort of the knowledge to invest, and wants exposure to real estate as an asset class, and is interested in seeing deal flow, is interested in sort of like evaluating and reviewing offerings within the space. So for some context, for example, we've got over 8,000 investors spread across 32 countries now. So that kind of gives you some level of context into the level that we work with. It's definitely not you don't have to be ultra high net worth, and you don't have to have $1 million to sort of allocate to this. Our firm, for example, our minimum check size is 25,000. So while it's not change you find in your couch, it's also not an egregious amount to sort of start to explore the asset class and explore this avenue of investing.
Yeah, I mean, as you say, I mean, it's not chump change, but at the same time, I mean, this isn't the large sums of money that one thinks about when you're talking about acquiring real estate. In my experience, people that like investing in pre-construction, there are a number of reasons, but one of them that's often highlighted is that it's an investment today, basically for tomorrow. So I'm putting down less money, and it's less of an impact, I guess, on me today in terms of my pocket and what's going to be hit. So you hit the $25,000, which I think is really relevant, because again, if you were purchasing a $1 million property that was pre-construction, which seems quite reasonable today, the expectation is that by closing you've come up with 20%. So that's $25,000, and then maybe you've got a payment structure that's 30 days, 90 days, 360.
Yeah, you have to have
and then
200K on that million. You'd have to have 200K.
That's
usually,
right.
like most deposit schedules on pre-construction are asking you to deliver between 15 and 20% over the course of 2 years. So the rule of thumb we use is you're staggering it into 4 payments every 6 months. And so in your example, you'd have to come up with 50 grand every 6 months. And then beyond that, and I'm sure you'd speak to this, is once that unit is ready and once it's ready to take title, you now have further obligation, right? You have development levies and charges, you have land transfer tax, you have to go secure debt, so you have to go find a mortgage.
Right.
So there's a lot of nuances that people sometimes sort of put aside because of sort of the thrill and rush of getting into pre-construction at the time of signing, and then by the time that unit's ready, 4 or 5 years down the line, all those things sort of come rushing at you at once, assuming you're not trying to flip that paperwork in an assignment or get out of that deal before all of these obligations come due.
Yeah, the fees that are levied against you are certainly a lot more than chump change as well. And you're right. You totally hit a lot of the great talking points there. I think that the other thing I was going to sort of touch on was in my fee structure, where I was saying, hey, you need $200,000. It would be really interesting instead maybe to diversify and have 50 in one project, 50 in another, and by the time you've added up to 4, maybe that looks a little bit nicer. Maybe you've diversified, so you're not only in the downtown bottom of Bayview construction project, right? So we were talking offline a little bit that a large element of your investment is GTA, but also you guys are diversified throughout North America, and what's happening in Atlanta doesn't necessarily reflect what's happening in Toronto. And so if your house is in Toronto and most of your investment perhaps is in your house, and then you're also investing in pre-construction that's in downtown Toronto, and then the Toronto market takes a hit, or something outlandish happens, like a ban on foreign buyers or vacancy taxes, or things that are implemented with high interest rates to try and hurt the real estate market. This is a really interesting way to diversify and to spend that money basically in a number of places to help maybe buoy the ship in different places, right?
Totally. And this, I mean, it's something sort of part of like my core responsibility within my investor base is touching on exactly that, right? So when we put out offerings and we do diversify offerings, right? So we work all over North America. Obviously, a majority of our work is in Toronto just because of our proximity to the region. Our HQ is here. But when we work with investors, a big element of it is ensuring that they're not over concentrated in any one geography, in any one sub asset class, right? So even, we take it a step further. Let's say someone has $200,000 to invest, and they're saying, okay, I'm going to put it across, let's say 5 or 6 projects, and every single project that they're investing in happens to be high rise, even though one is in Toronto and one is in Hamilton and one is in Whitby. But we take it a step further and say, okay, well, let's make sure that not everything is high rise. Let's get into a little bit of low rise projects as well, because to your point, the world and geopolitical things change, and demand for different types of products and housing changes. So it's a great way to sort of, let's say, use your example of, I have $200,000 I want to put into a pre-construction unit. Let's take that 200,000 and actually put you into a private equity offerings in, for example, 8 different geographies, types of construction plays. We do things that are like purpose-built rental plays. So now you've sort of taken that same capital and you've totally diversified your risk profile, and you've hedged against a bunch of different things, and you've sort of saved yourself all the nuances of having to, again, come up with the levies and fees and the mortgage and everything else. Our investment style is 100% passive. So you're literally just placing capital and sort of doing your diligence on us and doing your diligence on the offering and the project that we're executing on, and getting comfortable with that. And then you're just sort of letting us execute, which is our core competency.
So let's chat a little bit about some of those pre-construction fees and expenses that one can expect. So we were noting when we spoke in person that a lot of the fees have skyrocketed, right? I mean, what you used to spend 10, 15 years ago in terms of government or city costs, municipal charges, sewer charges, whatever it might be, those have taken a humongous toll, I think, on anybody who's buying pre-construction. And then there's also the huge element of needing to qualify for a mortgage, and what interest rates might be. It used to be that you'd be able to buy pre-construction and hold your interest rate for the 5 years until the property actually closed. No longer is that the case. Mm-hmm. So again, some of those fees I think are exponential from where they used to be. Could you speak to that?
Yeah, I think over the last 10, 15 years, the layer within your cost structure that's allocated to government fees and levies, both to the developer and to the end user, has really, really outpaced anything. If we're comparing it to inflation, or we're comparing it to cost of living or anything else, it's just heavily outpaced it. So I think when you're a consumer and you're sort of doing your calculations on whatever your goal with like a pre-construction unit is, assuming it's an investor goal, right? End users, I think, are a different bucket, and obviously they're getting different value out of that real estate. But if you're just looking at the fundamentals of math, and you're saying, I'm going to put this money down, and I'm going to get access to this unit in 4 years, and then in 4 years, what's the additional capital requirement over and above my purchase price? I would say, as a rule of thumb, you should be adding 20% to that original capital when you're factoring in levies, fees that are, for example, due to the builder, that are in turn passed on to the government, in addition to land transfer tax and legal costs and everything else. I think, if you're putting down 200K, have another 40K stashed away when it comes time to get those keys, because that'll usually sort of be the round number it adds up to when all is said and done.
Yeah, I think that sort of sits about right with me. The 15 to 18% of your investment, which is really, really substantial. If you were planning on profiting, you need to profit on top of the 15 to 80%, which I think is a heavy toll. There are commonalities, right? I mean, I think that the way that it works if you're buying pre-construction, obviously, is that your funds are tied up. That remains the case here, except you can't be using RRSPs, you can't be using TFSA, and these are registered funds. This is money that you can allocate as a true proper investment.
Yeah, we're an extension of like your investment portfolio, right? So a lot of people will, for example, have a IA, an investment advisor, or a wealth advisor, or they'll self-manage. but some people will sort of split their investment portfolio into multiple things. Some people go into alternative investment vehicles like art or crypto, or in my case, sports cards. So you sort of have your potential alt investments, then you have your traditional like IA portfolio, so you've got GICs or mutual funds, or you're investing directly in equities. And then you potentially have ownership of real estate. So you're a real estate owner, you're a landlord, whatever the case is. And then we're a layer that sort of you incorporate into that. So we're regulated on the Ontario Securities Commission. We sell equity in private offerings. Your private offerings, or our private offerings, generally speaking, on the vast majority of our projects, with a few exceptions, are eligible for registered funds. So they're eligible for RRSPs, they're eligible for TFSA, RESP, etc. You could also use, if you have a corporation that you'd like to use as your investment vehicle, that is an option to you as well. So it is a tax efficient way of getting exposure to real estate as an asset class, whereby you're potentially using funds that you traditionally wouldn't allocate to real estate, because you don't have that option, right? You can't sort of go put an offer on a bungalow tomorrow and say, I'm going to use my TFSA and keep it sort of tax sheltered to buy that bungalow. So when I sell it, any of my cap gains go back into my TFSA, and now I'm sort of made all this profit tax free. It unfortunately doesn't work that way. Whereas here, because you're buying equities, you have that ability, right? So you could put $25,000 into the Queensway offering. When the horizon comes and it's time for distribution, your 25 becomes 50. That additional 25K is now tax sheltered. It stays in your TFSA. So I always recommend people obviously get the consultation of their accountant, but we definitely lean on that. We definitely make sure that our investors are aware of sort of some of the tax efficient ways that they can get exposure to real estate, and obviously through our offerings.
Yeah, and it's also just so attractive, I think, from the other side, which is, that typically the complaint is that, hey, with real estate, your money's tied up, you can't really do much with it. Well, your RRSP is tied up and you can't really do much with it. And so why not use the tied up funds into the tied up asset class that you're, hesitant to be in? It seems to make a lot of sense to me. I'm cognizant that I know you've got sort of, limited time here, but we talked about some of the challenges with pre-construction, although I think it's to be said that there is potentially, I think, a lot of money to be made there, although there is more volatility as a potential. As a sort of value add, the investor who's buying basically into the private equity with the developer then has the ability to go in and get access to buying pre-construction.
Yeah, so I mean, again, every firm structures this differently. So I'll speak to Greybrook. So Greybrook, for example, as we speak today, has over 30 projects in active construction. We'll probably launch at least half a dozen sales centers this year across our portfolio for projects that are coming to be ready to be sold. So yeah, as one of sort of the value adds that we offer our investors is the ability to access those sales centers prior to public. So when you become an active investor within Greybrook, you are then invited to our sales center launches across our entire portfolio. So it is a benefit some investors love and frequently take advantage of. It's essentially the ability to get a peek behind the curtain on what is going to be sold, what the floor plans and pricing look like. And this event happens prior to public or any realtors sort of gaining access. So it's definitely a fringe benefit. It's obviously not like the core value. The core value is obviously helping you grow capital and building wealth. But obviously, a lot of people get excited about the end product, and whether it's the product that they invested in directly or a product that's outside of their investment but happens to be in our portfolio. It's definitely something that's available to the investor base.
So I guess sort of just to sort of toot your horn a little bit, I think at risk of your head maybe not fitting through the doorway afterward, but I think that it's worth mentioning that as we're talking about pulling back the curtain, I mean it's really it's a lot more than that, truly, right? I mean we're taking the computer apart and looking at all of the different connections and assessing the CPU here, because what you're really doing is you are breaking down 100 or so potential deals, coming up with,
Yes.
your 5 to 6 that are actually being, privately, publicly made available to investors. And people have a very, very thorough breakdown that's showing them basically, all of the inner workings. You are seeing the expected price per square foot that units will be sold at a year and a half before a sales center is even launched. I mean,
Correct. Yeah.
there's a ton of work that goes into this, and I'll be really happy to share with anybody. For example, you talk about the Queensway project, which is one that you currently have out there, and there will be another one as well if somebody doesn't want that for whatever reason.
Sure. Yeah.
But there's a lot of detail for anybody who's interested in sort of understanding how this works and what's available.
Yeah, I think one important thing that we sort of pride ourselves on is that we asset manage our own raises, meaning we're not just like a bank that writes a check or raises money from investors, and there's a third party that's sort of doing all of the work, and we're dependent on that third party to keep our investors updated and actually execute on the promise. So we're vertically integrated in that way. We do that in house. So all of the underwriting that you see in our offerings, and all of the evaluation and the projections and the way we structure our cost stack, and the way we expect to achieve returns, all of that underwriting is within our asset management team in house. And then by extension, anytime we update investors, and we issue an update every 6 months to our investor base via unit holder reports, that's also our asset management team that does that. So you wouldn't be tooting my horn. I think, obviously I'm wearing a Greybrook hat here, and I'm a big fan of the firm. It is a truly sort of best in class firm. If you sort of, take a look around or ask around about our projects and how we've executed and the type of stuff we've done around the GTA and abroad, we've really sort of built up a pedigree for ourselves. So yeah, it's definitely giving access to the investor base on data and logic, and understanding underwriting thesis on large scale real estate developments that you traditionally wouldn't see otherwise, right? So it's how we ideally educate our investors and make them comfortable with, this is what we're doing, and this is our thought process, and if they agree, and if they're confident in it, they're obviously proceeding, and if not, we always welcome the questions and the challenge, because it's always an engaging conversation.
Yeah, and I think just sort of speaking to it without necessarily sharing whatever the hopeful expected return might be, I think the point is that one can hope that they are outpacing most other investments, certainly secured investments that are publicly available.
Definitely, yeah. We definitely try to get into fairly aggressive return rates, well into the double digits, and sort of outpace what you could traditionally achieve otherwise.
So without much more, I just wanted to sort of say thank you. I don't know if there's anything else that you want to add basically before we wrap up.
No, just thank you as well. I appreciate you sort of bringing me on to your is this a show? Can I call this a show?
I'll take it. Sure.
Yeah, thanks for sort of bringing me on and chatting about the wonderful world of private equity. I think I think I'll just end with what you started with, in the sense that it's private is a word that's obviously part of the structure of private equity, and while it is private and access to deal flow is by invite, I just want to sort of tell your followers and your base that it's not just for the select few, or like the ultra high net worth, or the hyper connected. It is more accessible than that. And if anybody has an interest in learning about how it's accessible, or just learning more about how we work, I would say get in touch with Lani, and then by extension we can all connect, and you can make the intro, and we can discuss it.
Thank you. I'll leave that as the very perfect call to action that you left it with. If anyone's interested, this is officially your access to it, and I'll be more than happy to share Alex's details as well below, and look forward to continuing the conversation on it. Thanks again, Alex.
Thanks, Lani. Thanks, buddy.
Chat soon. Okay.
Okay. Take care. Bye.